you can see in the graph the guaranteed performance. It starts at 100% of the guaranteed power, then it degrades linearly, usually over the 25 years to give you a guaranteed performance. This is
so the way it works is that the manufacturer actually buys the insurance. Therefore, the buyer of the modules can simply ask his supplier to provide insured modules.
Another detail that doesn't go so much into the structure, but is also very important. You need to have proof of insurance that you are the beneficiary for the next 25 years.
Welcome everyone. Welcome to this webinar about PV warranty risk management. We'll wait another 2 minutes until everyone has joined. To start the webinar, we would like to run a poll. You can see the poll on the right side. And the poll is, have you ever filed a warranty claim for PV modules, for PV components? We'll share it now here on the right. Just to go over the agenda, the entire webinar is expected to take approximately 45 minutes, and after there will be a Q&A session. When you have a question, please feel free to type the question in the chat box, so we can see it. We'll answer as many questions as possible during the presentation and at the end. The session today consists of 2 parts. Sinovoltaics will start by discussing 3 warranty clauses that we recommend to pay attention to when procuring solar module. And after, we'll give the word to Munich Re, and they will tell you everything about PV warranty risk management. Just having a look at the poll, it's that so far 17% has ever filed a warranty claim. And as we have a variety of people here on the call, I believe this proves that it's a very relevant topic. So let me present the people here on the webinar. My name is Marcus Roy. I'm the Managing Director at Sinovoltaics. With my colleague, CTO at Sinovoltaics, Niklas Weimar. And next to me is Ronald Sast Solutions from our partner Munich Re. Also on the webinar as presenter, we have Julia Moser, who is the Senior Underwriter at GreenTech Solutions, Munich Re, and she's calling in from Italy. Good morning, Julia. Also on the call we have Michael Fremd, who's the head of GreenTech Solutions, calling in from Germany. Michael, a warm welcome to you, and thank you for joining us today.
Thank you. Good morning. This is Michael. I'm very happy and honored that I can participate in this webinar. I don't want to take too much time because I think you have a very interesting webinar ahead. I just want to set the scene from an insurance. Why is insurance in this industry? Why is insurance in the solar industry? Well, we try to help to grow the business. We try to help to enable the business, and it's I think a very common word to say risk is better spread amongst many. So if we distribute the risk, the individual can better plan, can easier plan, can convince his stakeholders, banks, lenders, and that's what we want to offer. We want to enable these new technologies within this new, I would say, industry or new energy industry. We've been doing that for over a decade now, starting with solar as the most promising technology, and we are still offering these performance warranties to enable projects to achieve bankability and financeability. We are also doing that in green tech for other technologies, circular economy, bioenergy, waste to energy. We are doing that for wind energy, of course, for fuel cells, but we are also offering these solutions for energy storage, for battery technology, including e-mobility. So we are really trying to overcome the hurdle of skepticism by many stakeholders, investors, lenders, by taking risk out of this equation. So I'm happy to participate in this webinar. And we, of course, we do have our internal expertise in-house, but we are not doing it on alone. We work with partners like Sinovoltaics to even better assess that risk. So thanks for the opportunity, and back to you. Thank you.
Thank you, Michael, for the introduction. Today we will look into 3 warranty clauses that we recommend to pay attention to. Here at Sinovoltaics, we help PV project developers to manage their technical risk when procuring PV equipment. Often we review procurement contracts, and warranty conditions are part of this. Perhaps we are not making ourselves popular amongst the factories to dig into their warranty conditions and advise buyers. However, warranty conditions are public and can be downloaded from the factory's websites. Let's start with clause number 1. You as the buyer have the burden of proof. With other words, in case you have a problem that comes up, you're responsible to collect evidence and present the case with the factory. But from the moment a defect comes up, the clock starts ticking. Several factories they impose a time limit for you to pay that claim. Let's have a look at some of the larger players in the industry. If you look, for example, at Solar, they have a time limit of maximum 14 days to file a claim. Jinko Solar has a maximum of 30 days. China, 60 days. And Longji allows to file a claim within the validity of the warranty period. So to put it in a nutshell, you receive a 12 years product warranty and a 30 years performance warranty. However, you only get 14 or 30 days to file a claim. Is that a reasonable timeline? Ask yourself. The second clause we would like to look at is the requirement to purchase from an authorized distributor or directly from the factory. If not, your warranty is typically not valid. Nearly anyone can purchase solar modules directly from a factory. However, this does not make them automatically an authorized distributor. Typically, for any warranty claim, part of the documents to provide are the original purchase contracts. But bought the PV modules from an unauthorized importer, well, it means your warranty was never valid from the start. And same counts for parallel imports.
Yeah, and I will present the third clause. And when you look at warranty conditions, another point that we recommend buyers to pay attention to are the installation and maintenance manuals. It's really necessary to strictly follow installation manuals because not following these manuals, it may actually lead to a void of the warranty. And installation manuals can actually be quite extensive documents. They're easily between 20 and 30 pages long. And some of these, they're very specific requirements. They can go as far as specifying the minimum size of the clamps that needs to be used for bifacial modules. Or they have specifications for the exact position of the clamps. So for buyers, we recommend that, for instance, for their EPC to be 100% in control of such documents and really incorporate these in the design of the PV plant. And aside from installation manuals, there are often maintenance manuals as well to follow. Now, these are only 3 clauses, and when procuring PV equipment, we really recommend to thoroughly review all the warranty conditions. Warranty is nothing more than a legal document, and the conditions are not carved in stone. So from our experience, these conditions, they can and they should be negotiated. At Sinovoltaics, we believe that, of course, the best warranty is buying a high quality product from the start. And an important layer of safety is, of course, warranty insurance. In this regard, I'd like to give the word to Julia Moser. Julia, please go ahead.
Thanks, Strikas, for the introduction. We are very happy to have this opportunity to present together with Sinovoltaics. Yeah, good morning and good afternoon, everyone. Ronald and me are going to talk about how the current market situation impacts warranty-related risks of PV modules. And after providing a short overview of the role of the insurance industry, and Munich Re in particular, during COVID-19, we're going to go into PV project development. We will focus on the warranty risk of PV, highlighting what buyers of modules pay attention to. So everyone participating in this webinar today has been or is still strongly affected by the lockdowns. What we know is that we are going towards a severe global recession. We see multiple negative economic effects resulting from the lockdown of infected regions, or rather countries, supply chain disruptions, and loss of demand. What we don't know yet is the actual duration, neither the intensity of further outbreaks, but it seems we're on a good way. The insurance industry is playing a major role in helping finance the COVID-19 crisis, both as an investor and as the industry covering insurance losses caused by the pandemic. And the insurance industry is in a good position to play this role. To this end, it does not require any governmental support according to the current information. So the important message here is that Munich Re will be able to withstand the financial burden of the pandemic, and the economic position remains strong even in the current circumstances. As not everyone in the PV industry actually knows Munich Re, I have decided to show one slide with some details. So Munich Re is the world's largest reinsurer, has been founded in 1880, so has been around for quite some time. The group result in 2019 was 2.7 billion euro, and we currently have approximately 40,000 employees. Reinsurance, primary insurance, and also asset management operations. We are present worldwide, which is also relevant for our topic here today. We have heard that Ronald is based in Hong Kong, and Michael, our head of Green Tech Solutions, is based in Munich. I myself am based in Milan. And Munich Re has a rating of AA-, which is also very relevant as we are talking about 25 or up to 30 years of insurance. So the impact on the PV industry actually started in January, early February, when the manufacturing of modules, components, and materials in China was disrupted by COVID-19 and efforts to contain it. In the meantime, the solar sector has adapted pandemic-proof manufacturing plants, and also the developers have their engineers back on site in socially distant ways. However, we are seeing a temporary drop in demand, leading to overcapacity, leading to price drops, and therefore an increasing risk of supplier insolvency. We don't know yet whether there will be any Corona funds for clean energy or something similar, but we from Munich Re are definitely seeing a higher request for insurance from both the developer side and also manufacturers of PV modules. Of the Chinese manufacturers we insure, most of them had taken up production again by March. However, not all of their suppliers were ready by then. I would like to emphasize how important it is to use high quality spare parts as mentioned in the corresponding bill of materials and the certification of the modules, because if the manufacturer does not stick to the IEC standard in the production of modules, the buyers of these modules actually risk that the modules might not be covered by the insurance if the BOM is not as in the corresponding certification. Now I would like to hand over to Ronald.
Thank you, Julia. So I would like to take the shoes of a PV project developer. So as a PV project developer or also a lender in project finance for PV projects, there are a lot of issues and risks that need to be addressed. So you will probably be heavily involved in analyzing and getting a good PPA contract, EPC contract, O&M contract. You have to take care of site permits and, of course, secure financing and many other issues. So you will be heavily involved, and just one of the issues, which is maybe not even on top of your list, is the PV modules. However, of course, these are the most important piece of equipment in your project. So you should at least address correctly the so-called warranty risk of solar in this development phase already. And because it will, in the end, influence the whole 25 years of your project. If you don't address it already in the development phase, there is later no chance that you could buy an insurance in the operational phase that covers the warranty. So the good news is there is a standard in the industry that offers PV warranty insurance, and we will present this here now in our webinar. First of all, I would take one step back, look again at the warranty risk of solar. We already heard about the warranty from Sinovoltaics. There are clauses in the warranty, and I would like now to show here a typical warranty standard or industry standard of a PV module. You can see in the graph the guaranteed performance. It starts at 100% of the guaranteed power, then it degrades linearly, usually over the 25 years to give you a guaranteed performance. This is a very strong warranty. First of all, because it's 25 years long. This is more or less, I think, a unique risk that we have here. No other industry has such long warranties. And also, it's an exceptionally strong warranty from the supplier in terms of that they will offer a repair, a replacement, or in some cases, also compensating of the underperformance of the underperforming modules, either in terms financially or by adding new modules. So these are also clauses that you should look at in your warranty, and you should be also aware that this supplier does not have the rating of an insurance company. It acts almost like an insurance system, but there could be, of course, the risk of insolvency of the supplier. And this is then what we call the risk of the warranty risk of solar. So the warranty risk of solar is defined as an occurrence of two events. First of all, an underperformance of the PV modules, which is a warranty claim essentially, at the simultaneously event of the default of the PV module supplier. So in this long time of 25 years, it's a very high likelihood that this could happen, that PV module supplier is just out of business. So when both of these risks occur, then we have a warranty risk event, and then the project is probably in trouble. So in order to address this warranty risk of solar, we have some key features. We need to look at quality assurance. So not only insurances, but also, of course, our partners like Sinovoltaics, they assist in the correct quality assurance. The certifications must be in place, bill of materials must be good, You can do factory inspections, you can do production supervisions, you can do extended reliability tests, and so on. These all address the quality of the module. Another key feature of bankable modules is the bottom, the supplier's credibility. The supplier needs to have a track record, which is sometimes listed in this Bloomberg Tier 1 list. It's not really a quality issue, but it's just a track record. Has this supplier already provided project modules to a project which was financed by banks? We have something like financial strength, of course, of a large or small supplier. Altman Z-score, we know it's a kind of financial metric that can be calculated to predict insolvency in the next 2 years. So these are all points that we should consider while kind of assessing the insolvency risk of a PV module supplier. And the third point, which is also a key feature of bankable module, is the middle point in green, is the warranty insurance. So in case now your warranty risk occurs, then you have a backstop that steps in, an insurance that pays the warranty claim instead of the insolvent module supplier. So we think that the low warranty risk and this high bankability, these are more or less the same. When people talk about bankability, they should not only talk about something like Bloomberg list, but they should really mean a low warranty risk. Then they will also get bank finance for these modules. So the warranty risk of solar can be now compared to other risks of your project. So we put it from insurance perspective now, the most severe risks in this pyramid at the bottom. So the fundamental risks are not, from insurance perspective, not the most probable risks, but the most severe risks. They should be insured. So something like external physical damage, such as natural hazard. This is an insurance that comes against storm or flood. And it is so essential because it will destroy the material assets, the equipment of your park. And therefore, it's at the bottom. And just at the same level, almost, we see the warranty risk of solar. It will also, if it occurs, destroy the material assets, the equipment of your park. Above, in the light blue color, is more what we call a temporary loss of revenue. There are also serious risks, but they are just affecting temporary loss of revenue, such as business interruptions due to political risks, could be credit risk, or a business interruption to physical damage. We have some O&M issues also seen here on top of the pyramid. And the very top is something like sun. The weather, of course, is also a risk, but more nice to have, or as insurance, I mean, nice to have an insurance against that, but it's more on top of the pyramid. So as I said, this warranty risk of solar is a fundamental risk which should be insured against. But in contrast to a policy for against storm or earthquake, so the very bottom, in contrast to a physical damage insurance, you cannot insure this on an annual basis. And normally, a physical damage insurance is placed on an annual basis because the risk doesn't really change from one year to the next. However, warranty is a 25 years issue. The risk changes. It can be higher in the beginning, definitely higher in the end. And that's why I said you will not be able to insure your project against the warranty risk for a, let's say, 10-year-old project. You have to address this issue during procurement of the solar modules. And therefore, we will now talk about the insurance that comes as a first layer while procuring solar modules. The correct way is to address this in the development phase in the procurement process. And with this, I will hand over to Julia, who will explain the first layer of this industry standard of PV warranty insurance.
Thanks, Ronald. So we call it the PV sales and buyers cover. I'm going to explain the structure to you. So the way it works is that the manufacturer actually buys the insurance. Therefore, the buyer of the modules can simply ask his supplier to provide insured modules. It's important to specify this because not all modules will automatically be insured, just the one that the manufacturer actually adds to the insurance by declaring them to us. So on this slide here, you see the illustration. On the left-hand side, the module supplier can actually decide which of his module sales are sold with insurance. In this example, it's project A, B, and C, and which of his modules are sold without the insurance. So the underwriting is actually handled by the supplier. Now let's have a look what happens in case of a claim. In case of warranty claims, again, here in the illustration, you see that project ABC, they would just, as usually, address their warranty claims to their module supplier. And the manufacturer would then have an insurance in place. And according to this, to the structure of the insurance, would be indemnified by the insurance. So for the manufacturer, this kind of cover is a balance sheet protection. So if we look at the key features of the sales and buyers cover, what's very important is that we offer high and dedicated limits, so no first come, first serve situations. Ronald will actually go more in detail on this later on because it is indeed an important feature that the limits do not decrease during the long time span of 25 or up to 30 years, and that there are no first come, first serve situations, which means that someone is being paid out and then the next one does not get anything out of the insurance. And the deductible does not erode the limits. Let's again have a look at the claims handling in case there are warranty claims, only that this time we see that the module supplier, so the manufacturer, is no longer in business. So for whatever reason, during these 25 years, the manufacturer has gone out of business. In this case, the buyers of the modules, so project ABC here, will be able to address their warranty claims directly to the insurance is an investment protection. So how do you, as buyer of modules, actually know from which manufacturer you can obtain insured modules? We have been approached many times in the past with this question. Therefore, we have created the PV Warranty Partner website. You can look it up yourself under here on the right-hand side. You can see the link. It's www.munichre.com/PV Warranty Partner. It will lead you to the site on the left hand. And what it actually means if a manufacturer is listed here below, it means that the manufacturer is a warranty partner if he has passed the Munich Re due diligence process. So we do our own audits. And the manufacturer has bought insurance capacity for at least 100 megawatt per year and is reinsured by Munich Re. And this manufacturer is actually able to register buyers of PV projects that are larger than 2 megawatt. So there's a threshold of 2 megawatt minimum for Munich Re's insolvency protection. Here. We have also created the warranty partner logo. Here on the top right-hand side, you see it. So if you see this logo, some of the manufacturers that are warranty partners, or most of them actually use it on their warranties, on their data sheets, on their website. But again, most importantly, always up to date. Check the website who is currently a PV warranty partner. I will hand over to Ronald again, who will actually compare our solution to others available in the market.
Yeah, thanks, Julia. So as mentioned, so you have to address to the supplier when you source modules that you want warranty insured modules. And at that point, you can, of course, look for our warranty partner list. But even if the supplier is not on that list and the project is large enough, you should ask this question to your supplier to source warranty insured modules. It comes at a very little cost. It's more or less a no-brainer. And if they are not listed on the Munich Re webpage, they can either be assessed by us very quickly, also with the help of our partners. And if they do not have our insurance, it could also be that they have insurance from another insurance company, which also exists in the market. And this could also do the same. So, but in order to make now an informed choice, the next part of the presentation will look now more into details of this PV warranty insurance. These are some questions that you should ask the supplier in order to understand the PV warranty insurance, because it comes in different shapes and sizes. There could be warranty insurance that help you better or not as good. I will also add a poll now, just to understand how have you ever studied details of warranty insurance before or while sourcing PV modules? So I would appreciate if you can also answer yes or no. And in the next slide, I will go more into these details. So while we are waiting, I will already start with the first question. It's very easy. How much, well, it sounds maybe, how much insurance capacity exclusively belongs to my project? This is a very important question. By insurance capacity, we mean usually the number in US dollars. So it's just an amount of money. So how much limit, we call it also limit of insurance, how much limit of insurance belongs to my project. And the second part is it has to belong to your project exclusively. So this is now illustrated in these two graphs. So on the left-hand side, you see the large blue circle, including the pie slices. This should represent the capacity in US dollar reserved for all the projects, is what we call the limit of insurance. So in case of an insolvent module supplier and a warranty claim by project A, the project A has access to its slice, which is proportional to the size of the project. So each project owns its own limit. Project A has a smaller slice than, for example, project C because of the size. This is how we distribute the whole cake, so to say, to each of these project owners in a fair way. And this will be in place for the whole 25 years. There is a second insurance structure in the market on the right side. So first of all, the insurance capacity is much smaller, which we can see by the small blue circle. And this, in case of a claim, also after the insolvency of the manufacturer, this insurance capacity is opened as a shared pool to all projects. So in contrast to having a dedicated limit, we have a shared pool in this case. And this can lead to a big problem, of course, when the pool is empty. For in this case, we see here the red projects, there's nothing left in this pool. So from a PV module supplier's perspective, this is also a viable solution, because when the PV module supplier wants to pay its claim with help of the insurance, they have access to a pool that is opened up as the claims come in. But from the perspective of the project owner or the project developer, in general, from the perspective of the buyer of the PV modules, definitely the left-hand dedicated limit is what you are looking for. Therefore, the question is, do you have dedicated limit? This is the first question. If you get a clear yes or a document that proves it, you have to go to the next question, and this is then how high is the limit, right? I mean, the limit is never 100%. This can be, I think, said. It's very unlikely that you will get a 100% limit. So there are limits in the market ranging from 5 to 10% from our structure on the left-hand side. These percentages are relating to the sales value of the modules. So when you buy the modules, then you pay, let's say, $100 million for the modules. Then you will, if you have 8% limit, have 8 million for the whole 25 years flat as your limit. This is a number that you should be aware of. In the example, I put 8% as the green slide. You cannot see what the smiley is saying, but the smiley is saying that this limit is active for the whole 25 years as a constant value of US dollar. On the right-hand side, we see also insurance structure that is in the market. First of all, the limit can be much, much smaller. Then you have to decide for yourself, is it sufficient? But the second point that we want to make, and which is not seen in this smiley, it says the limit drops after 10 years. So this is a kind of trick from some insurance companies to sell a 25 years cover, which is actually only a 10-year cover with a lower limit afterwards. This is something that you have also to decide for yourself if you need a 10-year or a 25 years limit. The point is you need to ask the right questions when you are deciding. The next point is already another detail that doesn't go so much into the structure, but is also very important. You need to have proof of insurance that you are the beneficiary for the next 25 years. So usually how this works is it's a 3-step process. In the first step, the beneficiary, which is the buyer of the modules, must be declared to the insurer by the PV module manufacturer. So if you buy modules from the supplier will tell us all the data that we need to register the buyer or the beneficiary as in our database. So in the next step, when we have registered the beneficiary, the project owner is the beneficiary, then we will issue a letter, which we call a declaration letter, as a proof of insurance to the supplier. And the supplier will then hand it out to you as a project owner. You can see an example of such a letter. The contents of the letter has sometimes more or less details depending on some requests, but you can see here one example, and it will definitely say the name of the project developer. It should tell the location of your park, the size of your park, maybe also the total sum insured of that park. So some information that will definitely identify you later as the beneficiary. And this letter in step 3, you can then present to your lenders or to the regulators or to the tenders that might have this insurance requirement. So to summarize maybe all these important details, we recommend to also put some insurance conditions in either purchase agreements or term sheets to make sure that you will also get warranty insured modules. So this is just an example. So I would like to show you this example, but the numbers are not fixed in the market. So to say that the supplier shall obtain PV warranty insurance with the following specifications. The first one is the insurance limit of at least 5, or it could also be 8 or 10 of the module value is dedicated exclusively to this project. I put here the number 5 just to also manage expectations. There will not be a supplier that can offer 100%. It sounds low, this 5%, but in comparison to the insurance market that is out there, this is probably higher than most other insurances would ever provide. And I can tell you that nobody has more than 10% in this kind of insurance in the market. So here you have to put in the number that will satisfy your lenders, and we have seen this 5% are doing most of the fulfilling most of these requirements. The insurance limit, now point B, the insurance limit must be for 25 years, for example. If this is, you could put here 10 years, but you should definitely fix it, and the insurance limit should not decrease in later years and is non-cancelable. Then the point C is this proof of insurance and also the transfer. This is a critical point, of course, that the coverage transfers to the project owner in the event of the supplier's default. Then you should put some kind of rating requirement there, because as Julia mentioned, the 25-year cover has very high demands for the stability of the insurer. So a 25-year cover should be backed by a reinsurer that has a very strong financial rating. And then the second point is this proof of insurance. We recommend that the supplier should provide you with a letter, so a proof of the insurance, within a certain time frame. So now we talked a lot about these limits, and I mentioned that it's hard to buy 100%. This has also commercial reasons and has to do with market conditions. This can change over time, and most of the projects are satisfied with something of 5 to 10% of limit. But there are projects that are required to have a higher limit, and there we have this so-called second layer of PV warranty insurance. It's a very simple insurance that should be discussed directly with the insurance company. So you see here the tower of 100% of the module value, which is the total project of modules, is the sum insured. And the percentage of the limit is now given as the first layer. This is what we talked about. And if this is required, we can place a second layer for additional premium and as an additional standalone policy from the project owner as insured on top. So this optional top-up cover, as we call it, can be customized, and therefore it should be negotiated with the insurance company directly. And you will have the options to top up the limit up to 100%. You could include a lot of revenue coverage, which would pay lots of revenue that is resulting from a warranty claim. So it takes time to repair a warranty claim or to handle a warranty claim. You will lose some revenue. This revenue that is directly linked to a warranty claim can be then covered in a business interruption insurance. And you could also cover transport or labor or testing costs. These costs are often not covered in the warranty of the supplier, and they are also not covered in the first layer of the warranty insurance. Yeah, this is already my last slide. So this first layer which we presented, and now this second layer as a top-up cover for the project owner. And with this last slide, I would like again to show you here our contact details. Please feel free to contact us, Julia or me. And then I will hand over again to Dricus from Sinovoltaics to moderate the Q&A session.
Okay. Thank you, Ronald, and thank you, Julia. Before we start with some questions. And if you have a question, please type it here in the chat. And we will try to answer any of your questions. Maybe we can have a look at the polls. I just see they're private, so I'm just going to tell you the results. So the first poll that we did, the question was, have you ever filed a warranty claim for PV components? And 36% of the people here on the webinar, they actually have filed a warranty claim in the past. So that's more than 1 out of 3.
Yeah, it's quite a lot. So
yeah, I'm quite surprised. It's higher than I expected.
Yeah, it's higher than I expected, and I'm now also sad that you cannot just talk about it, but please feel free to write in the chat your experiences and ask some questions.
Yeah, it also really shows the relevance to have the insurance backing up this warranty, and of course go over the terms that you agree with the factory. So okay, and then the second poll was, have you studied details of warranty insurance before sourcing PV modules? And the result is yes, 55%, and no, 45%. So almost 50-50.
Almost 50-50, yes. Very interesting. Much more than I expected, but it really gives a good light on the expertise of the audience.
Yeah. Let me see, there are some questions here. I think this is about,
yeah,
okay, this one?
Yeah.
Okay.
So we pull up a question. It says, for top-up insurance, what technical due diligence do you perform on the solar project? So in general, this can depend on the project, but in general, we have already done due diligence in terms of factory inspection at that point in time, because we only give a top-up cover if this underlying first layer is in place. So by providing the first layer, we have already done a factory inspection or a due diligence that goes beyond the factory inspection. It will include also quality management, it will call reliability tests, and we do this also with partners such as Sinovoltaics. And if we have them on top the second layer, the so-called top-up cover, depending on the size of the project and the exact structure of the insurance, we also do then inspection of the park. So we have inspected several parks, also one with the Sinovoltaics actually, yeah. And then we will focus at the module. So this inspection of the park will then happen after installation. And the focus of this inspection will be primarily the modules, the quality of the modules, such as EL, thermography, IV curves, and maybe Sinovoltaics. You can also comment a little bit on the type of due diligence that you do on the park.
Niklas, do you want to talk about this?
Yeah, I mean, so as Ronald already mentioned, we perform technical due diligence on existing parks or parks that have either been recently constructed or are basically changing owners in terms of an M&A. So there's different situations basically where due diligence is required. And so the aspects that we look at is, as Ronald mentioned already, is electroluminescence. We also perform infrared thermography with a drone basically, or also IV curve measurement. These are basically the essential and most important tests that we can perform on the module level on site at the park.
Okay, and let's have a look. There's a couple more questions. Is there a question too?
There's been one question, Enriquez, that in general the manufacturers don't show the actual policy for the insurance, which is correct. But however, you as a customer, you always have the right to ask for it. So what we, for example, in general provide to buyers of modules is the beneficiary declaration letter that Ronald has talked about before, which provides some details, or rather confirms that this project is actually covered by Munich Re. However, you will always have the possibility, it says in small letters at the end of it, that you have the chance to ask for the actual wording. Important is that you always need to ask the manufacturer for that. We can, in general, not provide it, but the manufacturer can.
Okay, that's and then there's another question. The question is, if the supplier's first layer coverage comes from a different insurance company, can we get the second layer coverage from Munich Re?
Yeah, it's a very good question because we get asked this a lot. The easy answer is no, and the reason that is that we need to have our due diligence in place. So first of all, we cannot do the due diligence for every project in the factory. So we cannot do a factory inspection. Therefore, we list all the suppliers that we have already whitelisted, so to say, in our insurance, and they have already insured with us. We list this on this PV warranty partner list. But if you have insurance from a different insurance provider, then you have also to ask the other insurance provider to give you a top-up cover or something similar. But we will then not be able to do it.
Maybe if I can add, this is Michael again. This is a very interesting topic because only a few insurance companies globally are able to provide a 25-year cover with the capacity and the strength of the balance sheet. You see many solutions, even if you buy them from MGA or some, let's say, marketing company, they are collecting capacity from other insurance companies to back their offer, meaning someone is covering the first 10 years, the other one is covering the next 15 years up to 25, or someone is covering the first 5% and the other one is covering the next 3%. So if you bundle these insurance offers, in case of a claim, you can be sure that there will be a dispute who is paying for what, because on a 25-year performance warranty, you have not linear, but you have a degradation over time. And then there will always be the challenge. Was it happening in the first 5 years? How should the slope have been in the first 5 years so that only the second insurer has to pay or the first insurer has to pay? So be sure that when you get your insurance cover, it comes from one carrier as one bundle, because then it's clear who is paying the claim, because it's the one insurer who is paying the claim and not one or the other. So that is, I think, a very important issue we see, unfortunately, in the industry.
Okay, thank you, Michael. Let's have a look. There are some more questions.
Okay, another one which is a bit related. So it says the supplier states that they will buy a general insurance not specific for the project. This is again a very good question. This is the slide which I explained with these pie cakes. So in this slide with the pie cakes, there are two different insurance structures in the market. The right one is not specific to projects. This is correct, and this is okay from the supplier's point of view to protect them. But if the project owner is seeking protection, you should definitely insist on having your own project-specific limit, which is here illustrated on the left side.
Okay, all right. Thank you for answering this question. Let's see, is there any other question you like to answer, or if you can answer?
I would actually like to answer one, which
is there an optimum minimum size?
Exactly, yeah. Go ahead, Trikas.
The question is there an optimum minimum size of PV plan that is worth of being covered by insurance?
Exactly. So as mentioned earlier, for the first layer of insurance, so the one that is actually obtained by the manufacturer, the threshold would be 2 megawatt, as we have mentioned. But I guess that Michelle is actually aiming more towards the question of buying a top-up cover that Ronald has shown on his last slide. So getting more protection up to a limit of maybe 50% of the project value. And well, I think it would depend a lot on the actual on the investors. We generally see that for larger PV parks, and if I say larger, I would say maybe above 15 megawatt, investors tend to ask for higher limits. So we would be able to look at the at providing a top-up limit. Yeah, this is a slide we of for parks that are maybe 15 megawatt and bigger.
Let me look at. Yeah, let's talk about the floating solar question. Is this
Okay, there's one more question about floating solar projects. It says, are these first layer and second layer PV warranty insurance more expensive for floating solar projects? Or are you not covering modules in floating solar projects?
Yeah, this is also a very good question. For the first layer of PV warranty insurance, we follow the warranty of the supplier. So in general, that means if the warranty doesn't exclude any modules that are installed on floating devices, and we insure this warranty, then we will also insure these modules. Because for us, then of course there should be modules that are working as on floating structures. But for us, it makes then no difference where they are really installed. This also we don't have any difference if the modules are installed in the desert or in the Antarctic or something. This is we are more or less agnostic to where they are, as long as the warranty of the supplier is covering them, and you have received your beneficiary declaration letter for them. Okay.
Well, that's good because we see more and more floating projects, and they're also increasing in size. So it's
there could be warranties that excluded. This is I think the point that we should look at. If the warranty has excluded it, and there are specific warranties that include it, so yes, it should be also a question then, yeah, for these warranty clauses that you will analyze hopefully.
Yeah. So it's highly recommended to confirm with the factory and to if the warranty is valid, and to really review the warranty conditions and see it covers the floating project. Okay. Okay. There's another question. It says, we're trying to commercialize our solar projects with a 40-year operational life. This is obviously driven by the financial benefit of doing so. Do we get a Munich Re support?
This is a very good question, because of course the longer you stretch your financing period, the more attractive is the generation from the produced energy. However, there is also an effect of cost of capital over the period of time. So if the insurance industry has to lock in a certain amount for potential claims indemnification over 40 years, this is well, contrary effect to the financial benefit on the one hand side. On the other hand side, the 40-year is really a long tail. I mean, we feel proud and comfortable insuring a semiconductor for 30 years, but that is where we stop currently. Not saying that this will not change in the next couple of years, but as of today, there is no cover beyond the 30 years, where we actually prefer class modules in the 30 years. We still have the limit for non-class on 25 years.
Also, interesting point, I think, where the warranties go, because the warranties are, in this sense, also getting more aggressive over the years. They're getting longer, they're getting steeper or less steep in terms of degradation curve. they are paying more or less. So this is also a market, I think, where the warranties, they will follow the technical arguments, so to say, of the module, but also some market-driven movements we will see. And it could be that we see longer warranties, but definitely we will see the longer warranties before we see the longer insurance.
Okay. Thank you, Ronald. Thank you, Michael. Let's see. There's one more question.
I already answered it, actually.
Yeah. Okay. Well, what we can do, any other questions that we haven't been able to answer, we will come back and answer them after the webinar by email, so that if there's any other specific questions that everyone will surely get a reply on that. Thank you everyone for joining the webinar. It's very much appreciated that you joined us today. Thank you very much all the presenters. Thank you, Julia. Thank you, Michael. Thank you, Ronald. Pleasure to have you here.
Yeah, thanks that we could join this webinar also.
Yeah, thanks for having us.
I would also like to give the...
Our pleasure.
My pleasure.
Michael, would you
participating in this webinar. I look forward to talk to you soon, because we try to inform the market also on other technologies we are looking into, for example, energy storage. So stay tuned for energy storage webinar, which is even as complicated as solar, because if you have different user profiles and different applications, etc. But for us, more intriguing and challenging, which makes our life more interesting. So stay tuned, and thanks for joining us here, and thanks to our friends from Sinovoltaics for hosting us.
Thank you everyone. See you during the next webinar.
Bye bye.
Thank you.
Bye.
Bye.
Bye. Bye-bye.
Visit sinovoltaics.com to learn more.